Central banks just started quietly accumulating silver right as every mainstream analyst told you silver was too volatile, too industrial, too speculative for serious institutional money. And they're pinning the whole story on gold being the only real monetary metal, like that explains why sovereign wealth funds and reserve managers are now showing up in silver markets in ways they haven't in decades. Here's what's actually backwards about that. Gold is the headline. Silver is the move. And the institutions that manage trillions of dollars in reserves, the ones that don't make emotional decisions, the ones that move slow and think in decades, those institutions are starting to show up in silver. Quietly, without press releases, without CNBC segments. And if you're only watching the gold story, you're missing the setup that might actually be more significant. I'm recording this right now from New York, and I want you to comment what day and date you're watching from, because I always love seeing how far these videos travel, and this story is still in its early innings. And real quick, if you value this kind of no-drama, straight-shooting breakdown, where we follow what institutions actually do instead of what they say, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here's the vibe that's been flying around. Central banks buy gold. That's the known story. That's the headline. Record purchases for 2 straight years. PBOK, Reserve Bank of India, Central Bank of Turkey, Poland, Singapore. Gold in, dollars out. You've heard it. But here's what's not making the rounds in the same way. Some of those same reserve managers and sovereign wealth funds operating in parallel to central banks are now adding silver exposure, not in the same volumes as gold. But they're there. And on the surface, you might think that's just following the gold trade into a related asset. But when you look at why they're doing it, when you look at what silver offers that gold doesn't, you realize this isn't just a spillover trade. This is a separate strategic decision based on supply dynamics and industrial exposure that gold simply cannot replicate. So I'm going to break down 3 things. First, what the evidence actually shows about institutional and sovereign accumulation of silver. What's reported and what's inferred from market behavior. Second, why silver makes sense as a reserve asset in a way it didn't 20 years ago. And what changed to make it attractive to serious institutional money. And third, what this means for you if you're trying to understand whether silver is a speculation or a strategic allocation. So let's start with what we can verify. Unlike gold, central banks are not required to report silver holdings in the same way they report gold in their official reserve disclosures. Gold is a Tier 1 reserve asset under Basel III banking regulations. Silver is not. So central banks don't have to disclose silver purchases the same way, which means the accumulation is harder to track directly. What we can track is market behavior. Physical silver premiums, warehouse drawdowns, changes in exchange-registered inventory, delivery patterns in futures markets. And what those data points show right now, as I'm recording this, is that physical silver is being absorbed at a rate that doesn't fully match the publicly reported demand from retail buyers and known industrial consumers. Someone is buying the physical. Someone is taking delivery. And based on the size of the moves in warehouse stocks, it's not retail stackers doing it 1 ounce at a time. Now, here's the clean way to think about it. When you see registered silver inventories at exchanges dropping steadily, when you see delivery volumes that exceed what the known retail and industrial demand can account for, and when you see this happening at the same time that sovereign wealth funds in countries actively pursuing dollarization are expanding their commodity exposure, the most logical conclusion is that institutional money is moving into physical silver through mechanisms that don't require public disclosure. They're using OTC markets. They're using private vaults. They're using commodity funds that can accumulate silver without triggering reporting thresholds that would alert the market. That's not conspiracy. That's how large institutions operate when they're building a position in a market that's smaller than the equity or bond markets they usually play in. Now here's where it gets interesting. Why would a central bank or sovereign wealth fund want silver specifically? Gold makes sense as a reserve asset. It's liquid. It's universally accepted. It has 5,000 years of monetary history behind it. But silver? Here's the argument that serious institutional analysts are making right now. Silver sits at the intersection of monetary asset and industrial commodity. It moves with gold when there's monetary stress, currency debasement, or geopolitical instability. But it also has a demand floor from industry that gold doesn't have. Solar panels consume silver, and it doesn't come back. EV production consumes silver, and it doesn't come back. Data center infrastructure consumes silver, and it doesn't come back. So when you hold silver as a reserve asset, you're holding something that appreciates with monetary pressure and also has structural industrial demand that supports the price independently. That's a different risk-reward profile than gold alone. And for institutions trying to diversify their reserve exposure, that combination is increasingly attractive. Here's a question for you. If you were managing reserves for a country that was actively reducing its dollar exposure, and you could choose between gold only, silver only, or a combination of both, which would you choose and why? Drop that in the comments because I read them and I want to understand how you're thinking about this. Now let me address the skeptical alternative directly. Could all of this physical silver absorption be explained by retail demand and known industrial buyers with no mystery institutional accumulation? Yes, it's possible. Could the drawdowns in warehouse stocks be a temporary logistical issue rather than a structural supply shortage? Sure, that's plausible. Here's how that narrative fails. Logistical issues resolve in weeks. Structural accumulation trends don't. If warehouse drawdowns were logistical, you'd see them refill. What we're seeing right now, as I'm recording this, is a persistent downward trend in registered silver available for delivery. Not a dip in recovery, a trend. And trends in physical markets don't happen by accident. They happen because more silver is leaving storage than is entering it. And the buyers taking that silver are not advertising themselves. And I'm going to say something that might annoy both sides. You can believe the institutional accumulation thesis and still acknowledge that silver is volatile, that it can drop 40% in a week, that it's not a safe haven in the traditional sense. Those two things can coexist. Silver being strategically accumulated by serious money doesn't mean the price goes straight up. It means the floor is getting built, quietly, over time. And when the catalyst arrives, whether that's a supply shock, a dollar crisis, or a policy shift that accelerates industrial demand, the market will discover that the physical was already gone and the price will have to move to find it. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. Institutional accumulation continues at the current quiet pace. Retail doesn't notice. The story doesn't break into mainstream media. Silver grinds higher slowly, frustrating everyone who expects a parabolic move, while the physical market tightens imperceptibly from month to month. And then one day, a significant buyer tries to take delivery on a large position and finds the registered inventory isn't there. And the price adjusts violently to reflect what was already true for months. That's within the set of things this market is capable of doing. Path 2. The story leaks, Or rather, the price action makes the story obvious. Silver's move accelerates, media starts connecting the dots between exchange inventory drawdowns and sovereign wealth fund behavior, retail FOMO kicks in on top of institutional buying, and you get a compounding demand event where every buyer is competing with every other buyer for a limited physical supply. That's also plausible. Both of these worlds can be true at different times and in different order. I'm not predicting which comes first. I'm saying the setup for both is already in place. Here's what to watch. First, watch COMEX registered silver inventory. This is publicly reported. If that number keeps declining week over week, that's your most visible signal that physical is being absorbed. Second, watch silver lease rates. When institutions want to borrow physical silver, they pay a lease rate. If those rates spike, it means physical is scarce and the demand to borrow it is high. That's a stress signal. Third, watch whether any official reserve disclosures start mentioning silver. Right now, it's rare. If even one significant central bank adds silver to their official reserve statement, that changes the narrative overnight. And fourth, watch industrial offtake data from solar and EV sectors. If production continues to accelerate, the industrial demand story only gets stronger, which reinforces the accumulation thesis. So what do you actually do with this information? Here's a simple action plan. No drama. Step 1. If you don't own physical silver, consider starting a position. Not everything at once. Start with a modest allocation. Enough that if it goes to $200, you feel like you participated, but not so much that if it drops to $70, you feel sick. Step 2. If you own paper silver, know the difference between owning a claim on silver and owning silver itself. ETFs are fine for trading exposure, but if the thesis is that physical is being absorbed quietly, the thing being absorbed is physical, not paper. Consider whether your exposure matches what you're actually trying to own. Step 3. Don't use leverage. If serious institutions are accumulating quietly over months and years, trying to speed that up with leverage just means you're subject to every short-term violent move that comes before the thesis plays out. Step 4. Be patient. Quiet accumulation stories don't resolve in weeks. They resolve in quarters, sometimes years. Write it down. Decide your allocation. And then let the market do its work. Now, here are my questions for you. Do you think central banks will eventually add silver as an official reserve asset the way they hold gold? And if the story breaks into mainstream financial media, do you think you'll still be able to buy physical at a reasonable premium? Drop your answer below and remember to include what day and date you're watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up when warehouse data or institutional disclosures give us more clarity. And if this helped you, share it with someone who only knows the gold side of the precious metals story and hasn't looked at silver yet. All right, stay sharp, and I'll talk to you soon. And just so we're crystal clear, this is educational content. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.